In the beginning of 2022, many billionaire fund managers have changed their market sentiment drastically. Many are recently becoming bullish on the market, which is completely opposite to the crowd. In the last 2 quarters, we have seen the likes of Warren Buffett, Charlie Munger, Bill Ackman, Jim Simons, Cathie Wood, and Chamath Palihapitiya invest heavily into high-growth industries like technology, innovation, e-commerce, and more. In contrast, there are still certain fund managers who remain cautious during this time. Managers such as Michael Burry are holding their ground in the belief that there will be a devastating market crash soon. This begs us the question whether we will see an upward shift in the global markets. In this video, we will take a deeper look into the contrasting fund managers' outlooks of the market and how the current environment may be impacted by these views. Recently, on the All In podcast, Chamath Palihapitiya declared that there would be another dip in the S&P 500 index. Chamath stated that large-cap companies would be negatively affected and the S&P 500 would bottom out at 3,800. The S&P is currently at roughly 4,200 points, which suggests that the one last dip is not too far away. The current market sentiment is that buyers are those of growth stocks and sellers are those of value stocks. This point is further supported by David Sacks, a billionaire entrepreneur and world-class venture capital investor. Sacks referenced a study showing how internet and SaaS companies' valuations have dropped significantly. EV revenue multiples have spiked in the 2-year COVID-19 period and have declined from November 2021 onwards to historical averages. There is a possibility that this may continue to decline further, but based on historical evidence, the bargain hunting period should begin now. Brad Gerstner's published a couple of charts showing basically multiples in the Internet Index and among SaaS companies over the last whatever dozen years or so. And what you can see is that over the last 2 years during COVID, there was a huge spike in multiples for Internet companies and for SaaS companies, and that over the last, really, since November, the last 3-4 months, has now come down. And as of, I would say, last week, it was right at it about the historical trend. And now it's starting to go under the historical trend. So from a bargain hunting standpoint, you'd have to say that this is the first time that we've been below the average for a few years. Now, it's not to say it can't go down even more, because in the same way that you can be above trend, you can also be below trend. And if this war escalates and metastasizes, it will go down more. But if this conflict can stay localized and the economy doesn't go into a recession because of everything that's happened, then yes, this might be bargain hunting. This sentiment is clearly shared by Cathie Wood, the CEO and CIO of ARK Invest, who returned 170% in 2020. ARK's ETF saw large gains, seen from shares in many unprofitable companies and cryptocurrencies. This was partly due to the underlying environments of low interest rates and extensive stimulus. However, ARK's flagship innovation ETF has recently been under fire. The ETF is down 55% from its 52-week high and down 22% year-to-date. ARK's investors are now facing a rising interest rate environment that stands to be much less forgiving to unprofitable companies trading at higher valuations. However, Cathie believed that rising treasury yields would not impact high-growth companies as much as it would to mature companies. The average drop in Cathie's top 40 stock holdings is about 41% over the past 3 months. In comparison, ARK's competitors are only down approximately 14% over the same time period. This larger decrease is attributed to the high-risk, high-growth, high-disruption stocks that ARK Invest favors. Cathie Wood, who favors companies that embody creative disruption, is not at all fazed by this drop. She claims that these losses are temporary and that the bottom occurred on January 27, 2022. Cathie also believes that the stocks within the ETF will rebound to prior levels and continue to grow from there. Her strong sentiment towards the market rebounding is reflected through ARK's investments, which have recently been skewed towards certain high-growth companies. Other fund managers have also invested in companies with high growth potential to reflect their bullish sentiments. Charlie Munger has recently doubled down and defended his position in Alibaba. He stated that the company is a dominant force in Eastern e-commerce and cloud and is expected to see considerable growth. Bill Ackman, who is usually apprehensive about technology stocks given their higher prices, invested in Netflix earlier this year. Jim Simons, the head of one of the best-performing hedge funds ever, Renaissance Technologies, bet on two of the most well-known meme stocks in the fourth quarter, AMC and GameStop. The various investments by these billionaire fund managers all have something in common. Their timing also plays a key role in understanding the behavior of these fund managers. All of these investments have been made in Q4 of 2021 or Q1 of 2022, which demonstrates that fund managers are finding a lot of lucrative opportunities in the current market outlook. Despite all of this, the tension surrounding Russia's invasions begs the question whether the market will continue to operate with some level of stability under the stress. The unprecedented sanctions imposed by various countries, including the US, has created a lot of volatility in the stock market and additional uncertainty. In particular, the US government has focused on placing financial sanctions against Russia. This includes limiting trade and financial transactions involving the breakaway Ukrainian territories, blocking assets of Russian state-owned financial institutions, blocking or rendering unavailable foreign assets of Russian elites that are close to Putin, and other financial sanctions. These sanctions have effectively created an economic war between the Western world and Russia. They have only ever applied these previously to hostile foreign regimes, such as Iran, North Korea, and Syria. The primary reason for this is to prevent Russia from accessing most of the substantial foreign exchange reserves and ruining their currency. This has led Russia to lose access to global debt markets. These sanctions also have an impact on the global economy. It brings more uncertainty towards the market outlook. This comes on top of an already unstable market, which is still recovering from the impacts of COVID-19. And this means that there will be increases in risk premiums across various asset classes. The sanctions will also be likely highly inflationary because they'll affect the Russian energy sector. Russia is the world's third largest oil producer behind the US and Saudi Arabia, so a substantial portion of the oil supply has been hit. This uncertainty has already been baked into the price of oil, which has increased by approximately $20 per barrel in the past month. If the price of energy continues to increase, then there will be higher inflation. This proves to be a concern, given that we've already been experiencing high levels of inflation and supply chain issues. The worst possible outcome of this would be high inflation and lower economic growth, which is also known as stagflation. Stagflation is when an economy experiences high inflation while simultaneously experiencing little to no economic growth. That would be a disastrous situation to be in because any attempt to slow inflation would only crash the economy even more. In addition to this, these sanctions put a further strain on the supply chain, which in turn drives higher food prices, increased airfare costs, and further travel restrictions. There were also concerns over the interest rates, with Fed Chair Jerome Powell stating that they are inclined to support a 25 basis point rate hike. He further explains that they would move more aggressively if inflation does not subside as fast as expected. Federal policymakers claim to be surprised by the persistence of high inflation, as they thought the rise of fast price increases triggered by the pandemic would be temporary. That has obviously not been the case. However, the Fed's prime focus remains on managing high inflation. Powell has reinforced that the Ukraine situation will be taken into consideration when assessing monetary policy changes, especially as supply disruptions become larger and longer lasting. There are still many events that are yet to transpire from the Russia-Ukraine war, and there is still a lot of volatility to come. However, these dynamics are not unprecedented, and the pandemic has shown that many companies are resilient, and some can even be profitable during uncertain times. The fund managers' behaviors show that the global economy will likely be able to withstand such an event. In saying this, there are some outliers in this mix, and one is Michael Burry. Burry sold out of most of his U.S. stocks late last year prior to any word on the Ukraine situation. This was in preparation for what he calls the mother of all crashes. By doing this, Burry managed to evade the stocks that have tanked following the crash, like Golden Ocean, Marinus Pharmaceuticals, and Scorpio Tankers. Since Q3 2021, those three stocks are down 25%, 44%, and 43%, respectively. On the other hand, Burry missed out on cashing in on some of his investments that increased in value, like Precision Drilling, Occidental Petroleum, and Ingles Markets. Since Q2 2021, those three stocks have all surged by 91%, 38%, and 26%, respectively. Burry is simply one out of many fund managers, and many billionaire fund managers are becoming increasingly bullish on the market. However, there are potential concerns that are currently impacting the market and will continue to impact the global economies into the foreseeable future. This leaves us with the question of whether the markets are in fact bullish or bearish. Even though the market is currently experiencing volatility, billionaire fund managers are ready to weather the temporary storm ahead. In fact, many of them believe that this will be the time of bargain hunting stocks and cherry-picking the ones that will really be the winners. Let me know where you think the market is heading and what your view on the fund managers' positions are. If you enjoyed this video, please hit the like button and subscribe, and I'll see you in the next